Hey, Trevor.
Howdy, Mr. Biggs.
How are you?
Good.
So I am trying to catch up on a couple of messages here, see where we are.
You
How far behind am I?
must get very far behind.
It is difficult to keep. It's getting very difficult to keep up. That is for sure.
Yeah.
Okay, so Bastion already posted, so I don't
Yep.
need to do that. That's good.
He's a smart young man.
Yes, he is. A lot of very, very smart people on this platform. I am reminded daily.
Hey guys.
Howdy, howdy.
Hey, Kevin, how
Good.
are you?
Hello, Jim. I'm good. How are you?
Hey, Vivek.
Hi Jim, how are you? Hey Trevor.
Peachy Keen.
Hi there.
Jim,
Hey.
how are you?
Good evening, everybody.
Trevor beat you to the punch tonight.
You know what happened? I was on here and I accidentally clicked off. And I'm like, I'm not getting on yet. It's already after 7. So in spirit, I was there.
You're always early.
I'm responding to a LinkedIn message from Phil. He's going to be down in the Keys for a while doing some family stuff, so he's not going to be around for a few weeks.
Yeah, he told me that he had to go down and do some work on was it his mom's place?
Mother-in-law's, I think it says.
Yeah, and I asked him. I said, "Well, can I bring my tool belt?"
Exactly. I'd be glad to help him out down in the Keys at this time of year.
Yeah.
It's a nice time of year. It's not too hot yet.
Yeah, I've got to get through this tonight though, down in the southeast, that tornadoes that are going on down there.
Yeah, it's crazy.
Yeah.
Guys, how are you?
Good evening, everyone. Is that Rick that's saying good evening?
That's right, that's right.
Hey,
Oh
Rick.
hey Rick.
I somehow managed to be there twice, probably because I refreshed my screen and I have no way to throwing that one out. But anyway, I just remain silent now.
Well, Rick, just so you know, we can barely hear you. It is extremely faint.
That is fine. I
Oh,
was
you're good
Oh,
now.
it's much better now. Yeah.
I remain silent now. Thank you.
So yeah, I guess we can give everyone a minute and then we probably want to get started.
Yeah, that would be great. And I'm glad you said something, give you the ability to screen share. So just so everyone is aware, when you're doing screen share, and I've not done much of it, so feel free to chime in here if you have something else to say. But you can, if you share a window, you can, it seems to me you can only share one window at a time. But if you have multiple tabs open, you can jump back and forth between the tabs. You just cannot have multiple windows. So if you have a window open and you want another window, you have to close that window and switch to the other window. But as long as you use tabs, you can just go from tab to tab. So that might be helpful for some people.
No, that makes sense. Yeah. So okay. Yeah, we could probably get started, Jim or Bastian. You guys want to start it off or?
Well, I only, the only thing I wanted to say is to remind everyone, number one, thank you very much for being on the call tonight. Appreciate everyone that volunteers each week to step forward and be the guinea pig. It takes a little bit of gumption to do that. So thank you. And always remember, guys, that this is for each of us to learn and for us to also help you hopefully see something in your underwriting that you may not have seen. And to that, I also want to say, if you're coming up in the coming weeks, go on to the platform and upload whatever information we can take a look at ahead of time to hopefully give you better feedback. So if you don't see a file folder already open for your week, just create a new file folder and upload the OM and the financials. And that way we can hopefully provide you better feedback. So, and at the very least, if you don't get it up there ahead of time, then make sure and add it afterwards so that we can go back and review. So, Bastian, anything you want to say?
The only thing I think want to say is if you haven't presented yet and you're interested in presenting, please, there's a sign-in sheet on the drive. Put your name on there. I would love to learn from you, your underwriting, how you do it. So I think there are still some spots left in April. So yeah, please go in there and check it out.
So does anyone else have something that they would like to say tonight, or any input? All righty, then it's all yours, Vivek.
Hey, yeah, thanks, guys. I think I've kind of connected with everyone except Kevin and Julian. Maybe even John Moore is someone I haven't connected with, but exciting to be here, present a deal that we previously put an LOI on, didn't end up winning. So that's a big caveat if you guys are looking at that. But so John and I took a look at this deal, I think about a month and a half ago. We've been underwriting this for quite a bit. Let me actually share my screen to give you an overview of what the property looks like, what the deal was about, and that kind of thing. Give me 1 second while I share my presentation. Are you guys able to see my screen?
Devon Place, Kansas City?
Yes, that's the one, Jim.
Okay.
So this is Devon Place in Kansas City. John and I took a look at this deal, spent some time, tuning up the numbers. Also shared this with several partners, and they gave us a lot of inputs as well. On market deal, not an off market. It's a 100-unit multifamily in North Kansas City. Brought to us by Marcus and Milchap. We've had some broker relations there. Very clean property. I believe it was 87 built, so about 34 years, which was when I was born. The current owner has done significant improvements on the roofs, and I'll go into the CapEx details in a minute, but looks very nice presented, and the unit mix was also something that really attracted us to this one. Let's look at the neighborhood and what it looks like. I want to say C plus neighborhood, definitely not the high A's like Overland Park are. For those of you who are not aware of the Kansas City market, the north part of Kansas City has a little higher income. That's where the airport renovations are going on. Where John is towards Olathe, Overland Park, those are kind of the higher end properties, which might be a good appreciation play. This one was definitely a cash flow opportunity for us. Median household income is $52,000. Some might call it a B minus. I think B minus C plus is a good characterization of this area. As for the proximity to different employment center, shopping center, retail, and that sort of thing, on the screen on the very bottom to the middle, that's Devon Place right there. One of the biggest pulls is the North Kansas City Hospital and Cerner, both of which are healthcare centric. So that is a good thing to have close to your property. There's also a shopping center right about a mile away from the property where there's Target, Chipotle, and that sort of stores. You you cannot make out from this map, but to the north west is the Kansas City airport, which is undergoing a lot of renovations lately. Plus, there's also the Antioch Crossing, which has a lot of shopping opportunities as well. So very ideally located and very close to the highway, which connects kind of the loop of the freeway there. So ideally located. This is going to be an aerial overview of what the buildings look like. They have predominantly 2 and 3 bedroom units. They don't have a fence around the property, which is a good thing and a bad thing. Shows that the property does not see a lot of crime. John actually walked on this property and then everything seemed to be in place. It was a good place to value add and bring it up to market rents. John, anything you want to share regarding? By the way, John Wires, he's a partner of mine. He is local to Kansas City, toured the property. And John, anything else you'd like to add? Overview of what the neighborhood looks like, the buildings look like?
Oh, as far as, yeah, North Kansas City area, can you hear me okay?
Yeah, here
I
you
can
go.
hear you okay.
Yeah, I mean, this is, I don't know who's familiar with KC, but above the river seems like, or where some properties you can still get some value. It seems like, because Cora Overland Park is Johnson County, as some of you guys know who've been interested in KC area, is pretty hot. I guess we found out this one's pretty hot too. So I used to work at that company there, Cerner Healthcare IT, many eons ago. But yeah, above the river in Gladstone, you're still good to go. More the northeast and east side, it can be a little bit sketchier in the urban core, of course. But this property has good area, a lot of retail along 210 industrial. A lot of good neighborhoods, and of course, if you go along, 29 there to the west, you'll be able to hit the airport. But yeah, goods of visibility. It's essentially a bunch of fourplexes they're all connected by middle stairway areas, and really good square footage. But overall, it's a solid property and well maintained. New roofs and new paint, and just is pretty much on what it came down to is the comps, even though the square footage is on the higher side.
Right. And yeah, just in addition to the North Kansas City versus Jackson County, this is a different county compared to the urban core of Kansas City. Jackson County on the south has, a few rough areas which you might or might not want to go into. But North Kansas City is definitely, workforce housing. Also have a little bit of new builds that are coming up recently, but definitely BC workforce housing on this one. Part of the reason that I got invited to do this underwriting is I've been using this new model by Sharpline Equity. This is a little bit different from the syndicated deal analyzer and the other ones that I've been seeing, Rob Beardsley and folks like that. So I'd like to, give you an overview of what the model looks like. Also, we can take that opportunity to run through the numbers and see what the assumptions have been like. So let me start sharing the analyzer and get into the weeds of this one. Do any of you have any questions before we go into the depths of the underwriting?
Has the property sold since you put the LOI in?
Good question, Pat. It's still under contract is what we hear from the broker. They did come in significantly, I wouldn't say significantly, probably close to $1 million over what we were comfortable with. Again, that's the going price for stuff in Kansas City these days. It's not sold as of yet. John, I don't know if you've heard anything different.
No, I'm sure it's still going through the process, right?
Yeah. So Yeah, good question, Pat. It's been a month and a half since we put the offer. Haven't heard anything back.
And just FYI too, I mean, you know, we're pretty competitive here. They've probably had a little bit over 20 offers on this one, and would we come in like 9.3, 9.4, and then they went with best and final, I believe, above 10. So we expect it to probably settle around 10.2, 10.3 possibly, and eight or nine people went onward there.
Yeah, the best and final round, right?
You know, with a good
Right.
amount of hard money too, a couple $100K.
So yeah, I mean, if there's no other questions, want to quickly take a look at the numbers. This model might seem a little different to most of you guys. You probably have been seeing different other underwriting templates. The reason I like this, and it does have its limitations, I'll get to in a bit, but most of the variables that you control for either your debt or your exit plan, your equity stack, and your asset details are in something called a dashboard. So all the blue cells are what you edit. All your good stuff, your complex name, your unit count, asking price, purchase price. You can even set your earnest money, your acquisition, your asset management fees here. On the debt side is where they have a lot more options. So I'll walk you through this. When you have a stabilized debt like a Fannie Freddie, you want to hold that for the long term, you can select that, and you see here it's a drop down, and let me know if the characters are too small. I can zoom in as well. So you see the loan amount here, all the things here. I've actually added something called a prepayment penalty, which as a few, I mean, probably all of you know that it's something that you want to account for during the sale or the refinance of the property. Down payment, interest rate, IO, and all of those. The one thing that I like is it's very easy to model bridge debt, and I'm going to zoom in quite a bit here so that you guys can see this. Bridge debt automatically opens up a new tab here where you can now get a snapshot of what rehab the bank is going to pay and what rehab you're going to put out of your own pocket. So this is something that not a lot of analyzers have. I'm not sure if any of the analyzers that you guys have as a vanilla model have this feature, but that's something that this one has. You also have you can also add a supplemental, and you can say it's on purchase or what year you want to go in as a supplemental as. So on the debt side, you can model a lot of different scenarios very easily. Refi exit, it asks you for the cap rate currently, your escalators, and all those good stuff. So project wise, let's get into the details here. The asking price was 10 million. We came in at 9.4, and you'll see why that is the case when we get into the P&L and the rent upsides. We got lender quotes with multiple lenders at 75% LTV, 3.5 interest rate, with about I think it was 4.321 step down. So that's why I modeled a 2% prepayment penalty. 30-year AM, that's pretty standard. In our normal criteria, we do not have in our normal scenario, I should say, we do not have a refi modeled, but we did leave these numbers in case we wanted to do a refi. So this does not assume a refi here. On the equity side, you can model your splits over here. And I'll spend a little bit of time into going over what the pref, accrue, and hurdles are. I'm sure most of you already know what those are, but just want to touch upon those. 75-25 split, that's just the GP-LP split. The pref is your preferred return, not the pref equity. The accrue is where you want to accrue until 7%. That is the preferred return. The hurdle is where you can say you want to do a 50-50 split after a 15 IRR, that's where you set. So say after 15 IRR, you want to go 50-50 for whatever you want. I mean, for whatever reason you want to juice up the deal for the GPs, you can do that. I'll revert it back to whatever we had. So we just modeled a straight split 75-25. Any questions so far on this dashboard sheet? I know there's a lot of moving parts here, but happy to answer any questions you guys may have.
I have Vivek. So thanks for.
Go ahead, Bastian.
First of all, that's great that you walk us through that. It's been a model that I've been looking for a while. I haven't really spent much time on. The hurdle. Can you only? Oh, I hear.
There's a bit of an echo.
Can you hear me? Oh, that's better.
Yeah.
Can you only calculate one hurdle or multiple hurdles?
Coming through on Brent. There you go.
Yeah, I think it's echoing from. Say that once more, Bastian. Let's try it at this time.
On the hurdles, can you only implement one hurdle or multiple hurdles in that model?
I believe the vanilla model that you get, it's only going to be one hurdle, although I haven't tried multiple hurdles here. Like, are you thinking more along the lines of after 12% a different hurdle and then 15 a different hurdle? I don't know if there's an easy way to do that, but I can check it out and get back to you.
That's fine. No, just curious if you know.
Sure. Yeah.
Vivek, I got a question. What do you mean by hurdle?
So John, sometimes deals are structured where let's just say 80-20, right? 80-20 until you have a pref return of say 8%, and then you have an 80-20 split. But if the deal does really well, say it returns 15% and above IRRs, I've seen a few sponsors do 50-50 splits over a 15% IRR.
Wow.
So that's to incentivize the general partnership team to do a good job so that they can cash out whatever is over the 15% as a 50-50 split.
Okay. Thanks.
No problem, John. And the other thing, this is not something that you would change on the dashboard, but I like this quite a bit because it shows you what the LPs are getting in terms of their returns, IRR, and the other metrics. But it also shows you what the returns look like at a project level. So say you did some sort of a joint venture where you put your own money equally, the numbers would look very, very close to what you're seeing here. Another thing that you could easily change is, say you wanted to, you had a bunch of rich friends and you wanted to do a JV instead of a syndication. There's an easy way to do that. You can just say 0% acquisition fee, 0% asset management fee. So there's no fees paid out because everyone is doing a JV. You just say 100% here and 100% here. So now you see your LP returns look exactly the same as your project returns because you're doing a JV. So especially for deals, below 3-4 million, sometimes if you have the cash yourself or you have a partner coming in, you could easily model that as well.
So Vivek, did you say that it had the ability for you to have, say for instance, you had 1031 money coming in to model the 1031 as it'll pull that out and make all the calculations?
On the 1031, Jim, what I've seen some sponsors do is, and it might be different from your experience. Usually when you're bringing in 1031 money, they want to see a good enough chunk of capital, say $500,000, $1 million. Usually they create a different class of shares for them. And that's something that you can do with this model. For example, class, let me see where I can change that.
Right below not used, you have class C.
Yes, correct. So say you have $1 million coming in as 1031 money. You see how this populates class C shares. So now you can say they get the same treatment, or you want to incentivize them. They get 70-30 splits, but they get a higher pref because they bring in $1 million. Now you see different returns for different. Just 1 second. I think I have to change
Vivek,
this
you
one.
can't do that. That
Yeah,
doesn't work.
yeah, go ahead, David.
So
What was that,
you're
David? Sorry.
1031 in, if
Mhm.
you're doing, say you do a joint venture
Mhm.
and you take it tenant in common and
Sure.
everybody gets pari passu.
Mhm.
1031 is property for property. They cannot invest in this LLC. That's illegal. They'll
They
lose their
they
tax.
come in as a 1031. They come in as a tenant in common, correct?
Well, it would have to be tenant in common.
Tenant
That's
in common.
correct. So you can
That's
have
correct.
your syndication can be one tenant,
Mhm.
and then the 1031 would be the other tenant.
Other tenant.
And
They
you
would
guys
also.
would, so they would get it on a 10, let's say, what do you guys need for equity? Well, let's just round it off to 4.5 million.
Sure.
So, or let's just make it easy, 5 million. Let's say you need 5 million in equity.
Mhm.
Then they would get 20%, and your LLC, your syndicated, both the GP, LP, they would get 80%. And then you guys would
80%.
do your take 20/80 on that.
Makes sense. On the 1031, yes, as David was pointing out, it has to be a tenant in common structure where they would own a percentage of the complete ownership. But say somebody wrote you a $500,000 check or $1 million check, then they would come in as a different class of shares, part of this syndication, not a tenant in common. So it's not going to be modeling your.
Hold on, Vivek. What'd you just say?
So I was just saying, somebody, if there's an investor coming in with a huge chunk of capital,
oh yeah,
through
not
the
1031.
syndications, not
Okay.
the 1031.
Yeah, yeah.
No. Yeah.
Yeah, so this Class C shares, it looks to me what you're modeling there is if you wanted to have, say, for instance, a note investor, a special class of shares for a note investor. But I'm trying to figure out if there's a way, using the fields that are already there, if there's a way for you to model it as if it were a 1031, and I'm not seeing it. If it is, is anyone else?
But yeah, what it's missing all the after-tax data that you would need to show the step up in basis, because in the 1031, it isn't just the investor's money that's coming over. You're also deferring your basis, so you get that adjusted basis when you dispose. And on the relinquished property, you have to bring that adjusted basis over and account for it, as well as your recapture. So your depreciation recapture, that also comes over. So in order for this to really reflect the true nature of the 1031, you have to have an after-tax structure. I don't see it.
And that mean, as far as criteria is concerned, you have to have the equity and the debt be larger than what you're coming out of, right? In order for you to qualify on the 1031?
No, it doesn't have to be. You just have
On the
to
debt
pay the
side?
boot on what you don't use.
Right. You'd pay taxes on the portion. If it were
Got it.
equal, there would be nothing. If it were
Sure.
less by 100,000, you'd pay on the 100,000.
Exactly.
And you
right.
can also split it up. I mean, if they can bring 50% of it to this deal, 50% to a different deal.
Into a different deal.
Right. What I was looking for though is not the full accounting, David. I was looking for just did it offer to split the purchase price off by that percent and just calculate everything then on a different purchase price, where usually you have to do it just by saying, okay, if this is how much was it, a $10 million deal? And if they were bringing 3 million, you'd have to model this on 7 million.
What I do like, Jim,
Yeah.
so far, I mean, we haven't seen the other tabs yet. I'm kind of liking what I see so far. This looks easy modifiable. So, we've talked about creating our own model. So far, this is the closest one I've seen that we got to add a couple things to it, but so far I'm liking what I see better than any of these guru models that are in there.
Well, I will say from this is the first one I've seen add the Class C shares. And correct me if I'm wrong, guys, you have a lot more experience than I do working with them. And this dashboard, you're kind of seeing all of the main numbers in one page.
Yep.
Which is nice.
Yeah. Well, the other thing is how it's utilizing the debt structure too, and the different ways to do the debt structure. There's just a couple of more things we have to add to it, like assumptions and stuff like that. But it's a great template to start with. So
Yeah,
I like it so far.
It's a good baseline model. Like the ones that I added on top, and I added quite a bit on the other tabs as well, which I'll get into. The prepayment penalty was not part of it. The cap rate escalation was not part. I mean, these are small changes, but they do give you the flexibility of tweaking those numbers every now and then. One thing though that I do not like about this model is it does not have the scenarios. It does not have the scenarios like how the Michael Blanc SDA has. So that's, hey, Brandon.
Yeah,
Did you
Brandon
have,
he keeps dropping off, and when he comes back in,
okay, sure, no
he's
problem.
he muted himself this time.
That's fine. That's fine. So yeah, the scenarios tab is missing, but yeah, we could definitely add one of those capabilities in. So any questions other than what Jim and David had?
Vivek, is Annie here?
Hey, Annie.
When you say that it's missing something that Michael Blanc SDA's model has, what is it exactly?
Sure. So Annie, you know how the SDA has different scenarios. Say you have a marketing package, and then you have your version, and then a different version.
Yeah.
That's something that is not supported here natively, but it's about playing with a few Excel functions, which I haven't attempted to do that because it'll probably clutter the model, but you can definitely add that, which is not currently existing as you see here.
Okay, I see. But so far I've seen with Michael Blanc SDA, people mainly use it with the scenario 1 and scenario 4, which is what the marketing offer and what the
their
people,
version
they
is.
want to offer.
Correct.
So
yes.
I don't think that it's really something that big, huge, big. Yeah.
Hey Tim, did you have a question?
I got him.
Oh, okay, no problem. That's fine.
Okay,
no,
keep going, Vivek. Thank you.
Sure, Annie. Yeah, thanks for the question there. Okay, on the actuals and the unit mix and rehab, you'll see a few differences from the vanilla model. Like if you download it from the website, you'll see a little different look. But what I have is pretty much what the actuals are. I think actuals are important to see because you want to see what the baseline is today and then go from there. A lot of models do use or have that visibility into what the actuals are, the T12 looks like. So here you just have your breakdown of the income and the expenses. And these are more that, this is something that I added on top, a little bit of customization where RUBS was a big thing that we would look at for most properties. So I would just go in and check with the property management and check with the broker to see what separate metering there is, what the bill back look like, what the, based on a percentage, you have these different bill back that you could do. So RUBS you calculate, and then this feeds into your P&L tab. So it's a nice little way to visualize what RUBS potential you have in this property compared to the comps. And you can also select when you want to start the RUBS. Most likely you would start RUBS 3 months out, 6 months out, sometimes even a year out. So you have the capability of doing that here. This again is not part of what the vanilla version would look like. Property tax very much depends on the county.
Can I ask a question?
Go ahead, David.
On the RUBS, one thing, it's more of a statement than a question.
Sure.
The one thing you have to be careful of, and of course this is going to be lease by lease, or property by property more appropriately. If the lease says that they have to, that the landlord's paying for water or paying for trash or paying for, you won't be able to execute the RUBS until the next lease agreement is turned over.
Absolutely.
So you have to be careful of that. So
No,
I like the
absolutely.
fact that you've got the RUBS starts in year. But when you said 3 months, 6 months, that worried me a little bit.
As leases roll over, absolutely.
Yeah, as leases roll over. Good.
No, in fact, usually we start RUBS in year 2 unless there's a good. I mean, one thing on this property was a lot of leases were month to month. In fact, I think 70 or 80%, and John can correct me if I'm wrong, 70 or 80% of the leases were month to month, which was concerning to us when we went in, but it also gave us an opportunity to go in, renovate units as and when they came due, which was every month. So that's why we are starting RUBS in year 1 here. Property tax. Property tax is an interesting conversation. This one, we did consult with a tax consultant on what the property taxes look like. There's usually millage rates, assessment rates, catch up to year 1, and so on. But you will see a little bit of a customization on this one, because towards the end, when we were making an offer, we ended up using the consultant's number over what we were computing based on our assumptions, which would be very close to what reality would look like. The next tab is where I have a bit of a customization here. So all of these tables show you what the unit mix is. It's just 2 and 3 bed at this point, 70% and 30%. This table here shows you what the current rent is. This table shows you if there's any loss to lease from the existing units. And this is a little bit different from what most models do. This is not part of the vanilla. This is a customization on top. So it's a little bit of my own addition here. And this is the table which shows you what renovated units could go or rent for. And if you see very next to it, right, there's renovation details here. You can select how many units you want to renovate. You probably want to leave a little bit meat on the bone for the next buyer, but it also prepares you for the worst capex. Say you want to do 100% of renovations, you have to raise all that through your equity. It also gives you a timeline of renovation, meaning you have about 100 units to renovate. How many months are you giving yourself? Are you giving yourself enough time? This is 4 units a month in renovations, which is quite aggressive. So it gives you an understanding of what your renovation timeline looks like. You can even select when renovation begins, year 1, year 2. That's something you can see. And also based on your due diligence, your conversation with the broker, you can also say what dollar amount you want to spend for each unit, which you can see here. And yes, there's a lot of information here, but here it shows you for every $500,000 you spend based on the numbers you've given us, you can get about $2 million of net worth added to the property, which is just quite a good ratio to have. $3 million of equity gain for about $750,000 of capex. It gives you a ratio of what your return on investment looks like.
Is that based on market cap rate or based on your purchase cap rate?
This is based on the exit cap rate, which we escalate it by about 7 to 10 basis points every year since we purchased. So it's the worst of the cap rates that you want to go with.
Okay.
Yeah. And again, it's say you're spending $500,000 in capex and you're only getting about $500,000 of value. You might as well have not done that because it's a wash. I mean, you would have spent all the time, energy, and money, especially, and you would not have gained enough value. So this is showing what your return on capital looks like, and this is something that is important to make decisions based on capex repairs.
And Vivek too, we
go ahead, John.
Just to mention, we ran this property with full renovation versus half or 3/4 because there was good room for rent improvement.
Yes.
Obviously, it may be a different story if there's a marginal increase in rent.
Correct. And yeah, John in fact shopped a lot of comps. We went through CoStar, property management, the broker list, Rentometer, secret shopping and whatnot. John spent a lot of time. We converged with these numbers, which were quite a bit, I mean, not quite a bit, but a little below what the brokers were saying. So you never want to go above the broker unless you have a significantly different story. That's what I believe in. But we felt really comfortable getting 1,200 because this is these 3-bedroom units were significantly big. It's like 1,800 square feet, which is
Wow.
like a townhome feel almost. Yeah, we were wanting to push a little higher, but we felt comfortable at 1,200. So again, I like the dashboard feel here where it says the average rent upside is about 178. Yes, it's aggressive, but there is potential in this property with the income bump there.
Vivek, can I ask a question?
Go ahead, David.
When you have a large unit like that, I mean, you're getting your are you guys not getting your market rents in per square foot? Are you only seeing per unit?
We were getting per square foot, which was closer to 75, 80 cents on the dollar, 80 cents per square foot.
So why weren't you comfortable using it?
Because most of the comps, David, were smaller units, and they get capped out at 1,100, maybe 1,200 a door.
Okay.
Yeah.
Good. No, great answers. I just want to make sure that you guys are looking at your price per foots.
Sure. Price per foot seems very low because the units are extremely large in size.
No,
But they're
you're
good size
answering it
units.
correctly. No, you did good. I just wanted to make
Yeah.
sure you guys saw the whole picture. Good. Thank you.
Right.
We'd actually had to kind of consider a little bit into the duplex market because of the size. So it was kind of a blend because like you guys know, there's no apartments that are 1,800 square feet, really. So, yeah.
Yeah, we could have pushed it another $50. I want to say easily, but I think given the other assumptions, we wanted to be conservative on this because a lot of it was riding on the rent upside, and we didn't want to, get in the mood of not conservatively underwriting, if you want to say that.
So Vivek, was that $1,000 current rent? Is that average or was that max?
Which one was this again, Bastian?
For the big one, yeah, for the big one. Is that max or is that average?
Good question. So we did see certain units at 1025, 1050, but certain units were also in the $950 to $1,000 range. So it was the average. It was not the max.
Got it. Okay.
Yeah, but we didn't see anything close to 1075 even. So we had a good bump there.
I got a question on the, this is a good looking tool, on the renovation details chart area. Goodness, if I could speak. Walk me through that. First column is units to be renovated 100%.
Mm-hmm.
Okay, the next column is units to be renovated 72.
That's for
the 72 or the 2-bedroom, 2-bath, right? Going back to the far side, number 4.
That is correct.
Okay. How do you get the 24, the timeline in months? How do you get that? Or do you put that in? The blue is you put that in, correct?
This is, so my model currently supports, yes, that's correct, Pat. This is something that you put in as a user.
Oh, okay. All right. So then you just came up with that. And then obviously now for the subsequent ones, are they blue too? Because that one below it doesn't have a blue on it. Man,
this one?
Goodness gracious.
What was that, Pat? Sorry, the last thing cut off there.
The one below it is not a blue. Does that carry down from the one?
Yeah, it just carries down from here. So
okay.
Yeah. So yeah, you could customize this as well, but usually you would have pretty similar timelines for all units, which I thought was simple enough to do this, but absolutely you can customize this one.
Okay, oh, that's cool. That's an interesting way to do it. I haven't seen that. I just want to see if there's a different calculation, like a standard of, okay, you can do, 1 unit, 1 2-bedroom in, a month and a half or whatever. But okay, that's good. Thank you.
No problem. And we're digesting a lot of things new, but This is something that I pulled off from another. I took this one from Think Multifamily's underwriting tool. So what they do is they don't burn the loss to lease every year. They say, hey, show me this as a business plan. Show me how many units are getting renovated. And that rehab schedule was a pain to get it integrated with this. Again, this is not something that I created. This was something that I thought was very useful. So I'll walk you through this. I won't take more than 2-3 minutes, but I'm sure this will be useful for you guys. This is what happens under the hood when you say 24 months. It has 72 units, and you're saying you're giving it 24 months to renovate the whole 72 units. So cumulatively, you're doing these number of rehabs per month. In month 1, you have 3 2-bed units coming for renovation. And you see how it trends to 3, 6, 9, 12, 15. So in 1 year, you have half the units renovated because you gave it 24 months. And if you scroll to the right, you see in year 2, you pick up from 39, you go all the way to 72. So now your math has translated into a business plan, which you can now share with your property manager and tell them, hey, these were the number of units I had to have renovated by month 8 or month 9 or month 12. And it kind of serves as a plan for the property manager to go and do those renovations, or your business plan. Similarly, you have tables which can compute what your rent from renovated units looks like. And again, all of this data is not something that you enter here. It's all getting pulled from, where was that again? It's all getting pulled from these tables. And then it feeds back into your P&L. Sounds a little complicated, but it gives you a different view of how you want to look at renovations than just saying, I'm going to burn off 10% loss to lease in year 1, 20% in year 2, 30% in year 3. It gives you, this is more of a real world look at what those numbers look like and what the business model can look like.
I believe.
Can I ask you,
sorry about that.
Yeah, can I ask you a question? Oh,
go ahead.
Oh, sorry.
Go ahead, Darryl.
Can you go back to the month for the renovation of the units?
Sure. This is the one that you were looking at.
Right there.
Yeah.
So do you feel that renovating 4 units per month, do you think that that's maybe, and I came in late, so you may have already explained this, but do you feel that that's maybe a little too aggressive to, not unless these units are already vacant, do you think, well, first of all, let me ask that question. Are these units already vacant?
No, these are definitely occupied, Darryl, and good question on the, the schedule. The reason we felt comfortable going in with 4 units a month, because I mentioned this earlier and you're not part of the meeting then. I want to say 70, John, was it 70 or 80% of the leases being month to month?
Yeah, most of them were of that.
Month to month. So we didn't have to wait a whole lot of time until those became due. And it was, if all of them were yearly leases, we would not feel comfortable at 4 units a month.
Okay, so you said these are month to month, right?
Most of them, yes.
Most of them, okay.
Mm-hmm.
And they a lot of them. So on a month to month, I'm just thinking you're going to do 4.
Mm-hmm.
What is your renovation time? Will it be less than 30 days, or because that's going to carry over? If that's what I'm thinking. No,
good question. Renovation times typically 3 to 4 weeks, which is close to the 30 days that you're talking about. What was the carryover part there? I didn't quite get that. No, with the renovation time, if you're talking about doing 4 units per month, then if it takes 3 to 4 weeks to renovate 4 units, then what you're going to have is some of those units are going to carry over into the next month, where you may not be able to do 4 units the next month because you're already carrying over maybe 2 of the units. That's the reason why I was asking. Sure. And part of the way that we account for that is increased vacancy. We do have the vacancy variable to play with, but I do understand you have four weeks to kind of renovate those 4 units, plus you have lease up time, so you will see an increased vacancy at that point. But the business plan idea here was you have a couple of crews come in and get these renovations done, so that you have a pipeline of units which were being turned over. And we did also plan to have a leasing agent or 1.5 people helping with leasing, at least in the first 18 months,
Right.
to get them up and leased up soon and convert them to yearly leases. So we did budget that in the payroll as well.
And do you know if the property manager was able to tell you what's the DOM for those for apartments, and that's similar to this in this neighborhood?
You mean the leasing time period?
Yeah, the days on market.
The days in the property manager, it's a funny story actually. The property manager that we were consulting with, and John has a property with the same property manager. They used to manage this property a couple of years ago, but then the owner decided to go a different way. They wanted to self-manage and that kind of thing. So they know this market really well. They know this building really well. So they said within a couple of weeks, you could get these market trends. And the property manager was pushing us hard to go beyond what our rental upside was. But we were very cautious in saying, no, I mean, we'll hold you accountable to those numbers, but let's model it this way in our underwriting.
Yeah, to be conservative. Okay, I get that's good. Thank you, sir.
No problem.
I got
there.
a couple questions.
Sorry,
David.
Oh, David, go ahead.
So first, John, the property management company that you guys were looking at, and you may have just had a slip of the tongue when you said this, Vivek. You said that the property management company would do the renovations. Was that just a slip of the tongue, or did you mean a project management team?
Property management would oversee them, but we would have a project management team go in with a renovation crew and so on.
Okay. So John, did you use them to renovate the property you currently are using them on?
Yeah, we have a few choices. So they're, I don't know, like 30, 40 minutes from each other. So it would be either same or one of the variants.
Okay, my concern there, and I've seen it over and over again, is if you have a property management company that's doing the renovations, that's not their specialty. Their specialty is leasing apartments and maintaining relationships. And so you end up going over budget and over time because of that. That's that. You guys look like you considered all that. So that's good. Second question. You are assuming month-to-month leases. Well, okay, so January comes around and you want to do unit 32 and you're 100% occupied. And unit 32's rent or lease is month to month. Or are you just giving them 30-day notice and telling them, nice seeing you, out you go, even though they've been paying every single month and are good tenants?
We checked this with the property management. Good question, David. So we went in with an approach where, say, they didn't want to leave for whatever reason, and John's been on the asset management side on his property in the Kansas City metro. We are seeing organic rent bumps happen in Kansas City for, John, what was it, like $40 to $70 even without renovations?
Right.
On units like this. So we would try to put them in a vacant unit once it became empty. But if they did not want to move, then we would do an organic rent bump and see if that created some vacancy for us to go in and renovate those units. So even with organic rent bumps of and $40 is something that is pretty standard what the property management has been doing in these number of sized buildings. So that's something that we would do if the units did not become vacant.
Okay, well, that's fine. And I've seen people do that, and there's nothing wrong with that. The only thing you have to be careful of is if you're forcing people out, you're going to get a bad name right off the bat. And that's gonna
Absolutely.
spread.
Reputation,
Yeah, you gotta be-
reputation is everything, right?
Yeah, you got to be careful there. So definitely try to move him into another unit. That's the best move. Keep him on the property, move him
Correct.
into another unit. And if you got to
And
do a
again-
rent bump, I like the fact that you guys are doing the market stand 40. Yeah. And now if you'd have said $150, you'd probably be fighting them in court and you'd lose.
No, good question there. But one more thing that we wanted to make sure was we didn't overspend the capex if we were getting organic rent bumps. Of course, no one wants to do that. It's money sitting with you. But if you can get $40 to $70 of rent bump, even without, with just a basic clean, why wouldn't you do that in lieu of going and doing the full renovations? Yes, it's going to be not as high as the rents that you were expecting, but you also save on a lot of capex. Plus, you don't want to create a reputation of, the shark landlord where, you get driven away and then things like that. Yeah.
So one last question. As aggressive as this rehab schedule is,
Mm-hmm.
are you planning a 4 or 5 year sale? Are you doing a flip here?
No, this was definitely going to be a 4 to 5, maybe even 6 year hold with a refi.
That's still a flip to me.
4 to 5 year hold.
Yeah, that's the value add rehabber model. I consider that a flip. But okay, that's what I wanted to know. But so you're renovating all 100 units. What you leaving on the bone for the next guy?
Exactly. I mean, we were underwriting to a 100% all the 100 unit renovations just to get a worst capex number.
Okay, but that wasn't going to be the plan.
That wasn't going to be the plan in 24 months because nobody likes to buy a turnkey property in multifamily.
But you're showing it on your business plan that you are.
Yes, but if I change these numbers to say 50 to 70%, then now the capex reduces, the numbers look a little better. So this was going to be our worst case scenario, and we would tweak based on how things would go.
I got it. Good answer. I know how to fix it now. So
can I ask a question?
Good. Yeah. Go ahead. Sorry.
I think Tim had his hand up first. I'll let Tim go first.
Go ahead. Yeah.
Hey, thanks, James. I got a quick question, Vivek. And I don't know actually that market at all, but what if you can't you can't basically renovate 4 units a month? What are the evictions look like? The process, the length, how many tenants can you evict in this time? Just thinking ahead, what if it actually throws off your renovation schedule? Because you can't move 4 people a month and do your renovations.
Sure. I mean, the collections on this have been have not been less than 90%. So collections have not been an issue here. Although there are some people who have some balances on their rent side. What we plan to do was not go the eviction route, as I was suggesting. We would do an organic rent bump of $50 a month, give or take. And also see if they could move to a unit which would empty up a unit and then go in and do the renovations there. But evictions were not something we were thinking of, just to put them out, and because there was no real reason to do that because the collections were really good. And John, do you see any eviction problems with this one? I don't think it was very.
No, I mean, it wasn't affected much during the pandemic times as far as bad debt evictions. It was pretty low, so it's pretty strong, stabilized property.
Yeah, in fact, T3 looked much better than T6, which looked better than T12. So it was an out-of-state buyer, out-of-state owner, which who had tried to do something different, gotten his hands full, and was trying to exit the property. So it was not rent collections which drove him off. But good question there, Tim.
Well, this is what I was thinking. You got 70 units that are paying month to month. Once you start bumping the rents, and they might be actually under the market, and there is no pressure for them to pay what's on the market, they're still considering living in there. But once you start bumping the rents, then I don't know what can happen, you know, you might get that flow of customers or clients that don't want to move, they don't want to pay higher rent. I don't know what's happening in that city.
No, I like the question, and we did talk to the property manager, and John's also has a property there. So the idea was not go rock the boat and send a message saying, hey, the new owners have come in, they look like sharks, they're going to bump your rent, so everyone leave now. We didn't want to do that. So the first, we would definitely do exterior renovations. There was a bit of pavements that needed repairs, and show that we cared for the property and everything. But I think it was going to be a gradual process to get them used to the renovation cycle, get them used to the organic rent bump and so on. With 70 units being month to month, I think it's a big risk if you come in and say, hey, we're just going to renovate units no matter what you're going to say to us, because that's going to send a bad message to the neighborhood.
Okay, thank you. I'll throw one more question, but if you
Right.
could answer it after James, because James, I don't want to take anybody's time, but I was
That's
just
fine.
wondering.
Go ahead. You can ask. Go ahead, Jim.
No. Shoot, just forgot. Yeah, if I don't know if you guys hiring a third party property management company, it sounded like you did.
Yeah, we did. Yeah.
Do they charge entire month or half a month for leasing or placing a tenant placement?
Good question. I don't believe there's a half a month, 1 month charge, but John, can you confirm that?
I think it varies depending on the property. I
This
believe
size, Orion, do they charge?
I believe they might do. I believe it's half a month. Yeah.
You might want to add it to your renovations budget, because that's gonna if you're gonna do 4 units a month, you have to add it up.
Yeah.
Right. If you're gonna bring new tenants, you're gonna have to add that cost.
No, that's an expense that we might not have accounted for. Good point, Tim.
Okay, sure.
Yeah.
All right, I'm all done.
I would not account for that in the renovation budget. I mean, you can on the outside, but that's an operating expense. It's not a capital expense. So
Right,
make
right.
sure
Yes,
you account
thank
for it in
you.
your operating expenses.
Right. I
As far as
misspoke.
marketing or lease up fee
Yeah,
or
advertising,
what kind of thing?
advertising and marketing is where it fall under. Yeah.
Sure.
Got a quick question, guys.
Go ahead, Shane.
David, you might be able to answer this too, or anybody. It's about renovating 100% of the property of the units or leaving meat on the bone. I hear, David, you asked why you're not leaving meat on the bone. Just what's the benefit of not renovating or renovating all the apartments? I mean, as a potential new buyer, would you want a property that's been 100% renovated? You don't have to budget for CapEx and things like that. We always mention leaving some meat on the bone for the next buyer. I gotta get a little confused with that sometimes.
Well, I'll tell you one thing, James. And not in reference to this deal. What I'm going to say is not in reference to this deal. Okay. It's in reference to what I'm looking for. So I have a criteria that I'm looking for in a multifamily. If this particular building meets my criteria, my plan is to hold that building. My plan isn't to sell the building. So in that case, I would budget for 100% of the renovation, because that building will be passed down to my grandkids whenever they decide to get here. Right. So that's that. Now, if I happen to acquire a building that I don't plan on passing down to my grandkids, then I may do just that's going to be like a 3-5, or I may hold it 3 years disposition 5 or 5 year disposition 7, because I'm going to let it go. And then I would leave some meat on the bones. I wouldn't renovate all of the units. So for me, it depends on what am I going to do with this particular building? What's my strategic plan? Is it going to be a legacy hold, or is this going to be, as David said, nothing but a fix and flip?
And to add on to that, and very well said, Daryl, to answer your question, James, think of yourself going to acquire a property and 100% of the unit, and I have one here in Mobile, 100% of the units are renovated. but it's got 52 vacancies out of 200 units. So that's the meat that's left on the bone. It's got an occupancy play. There's a way where you can force appreciation. Most companies that come in at the level we're all operating at, not institutional. Institutional will ask that exact question you just did. If all units are renovated and they're very close to market rent and I can get a yield play because that's what they do, then they'll come in and they'll snatch those up all day long. That's the class A's. That's why they're snatching up the A's and B pluses. But for the value adds, in order for it to be a value add, there has to be either a rent play, an occupancy play, or a renovation play. You have to have some way where you can force appreciation. If you don't have it, it really doesn't meet any of our criteria because we're not yield investors. Unless you do what Daryl just said, which is me all day long. I'm just going to be honest with you. I mean, I'll do what you guys want to do when I'm investing with you, but I prefer legacy wealth, and that's what I'm looking for.
Exactly.
So if you want to renovate all 100 units, let's hold this son of a gun for 10, 20, 30, 40 years. And then let's go on down the big road and just build some wealth together. In that case, yes, we're renovating all 100 units.
Gotcha.
And Jim, just to add to David's point, your buyer pool is what you want to always look for. Like 3 years, 5 years down the line, who you're going to sell this to. I mean, 100 units is probably not going to be institutional buyers coming in. They're going to be private players like you, like me, who are trying to find some play in terms of income, expense decrease, or whatnot. You want to market to that segment, which is why you want to leave a little bit of meat on the bone. But David and Daryl, when it comes to legacy wealth, are you guys trying to see if you want to do a JV or a syndication where you would cash out the passive investors? How are you going to do that? I'm just curious.
You want to go first, David?
Yeah, you can write it in to the operating agreement where you, instead of a refi, you're basically buying your investors out, and you just give them a certain percentage, whatever that percentage is, and thank them for playing and have a nice day. And as long as that was your exit strategy in the beginning, and then you continue to hold. And any of the investors that want to stay with you for the legacy wealth, they can stay with you.
They could stay with you.
And if somebody wants out at a certain point in time, you just buy them out and they can go out.
Got it.
That's how I do it. Daryl, what do you do?
Well, my plan was, if I acquired the property, then I was going to try to get debt that was at that time it was I do believe it was a 5.7. No, it wasn't a 5.7. Either way, my plan was to I will go in, and then when it's time before that balloon hit, I would refi the building, give the investors back their money.
Sure.
Right. But I would
cash out. Yeah.
Right. But I would keep them on the deal. But the only thing is I would reduce their equity
share.
But they're going to stay on the deal for at least another 5 years. And then when it's time for me to refi again, that's when I would then just cash them out, hopefully transfer them into another deal. And they will also receive, of course, the profit, the split from the proceeds. But then I would just hold on to the building. I wouldn't let it. I would just hold on to the building after that.
Yeah, and to piggyback on what he just said, when you refi out, even if they stay with you when you refi out, if you can do a cash out refi that is enough that they get their return of their money back,
correct,
plus their preferred return that they get, if you can get that back to them, I have in my operating agreement, and I didn't ever have anybody disagree to this, we now go to a 50-50 between the sponsor and the investors, because everybody got their money back. Yep. And now we're just going to hold for legacy wealth.
Yep.
If you want to take your money and go, thank you. We'll love you to play with us again in the future. Everybody else, let's enjoy the ride and let's build some wealth.
David, I'm with you on that, David.
Daryl, so question for you too. I totally agree with you. What do you guys think? I know this is a great plan and I'm in the same boat. What do you guys think about the area where the asset is? I mean, do you consider the area, if it's getting worse, holding an asset in a declining submarket or market for 20 years might not be sufficient, or might not be profitable enough long term. Do you guys consider that when you think about building the family wealth and holding it for a long time?
I'm more concerned with a market declining, stagnant, or growing if I'm doing a 5-year flip, because then I'm trying to time the market.
Right.
If I'm holding for legacy wealth, all the trend lines have shown us in every market in the country, except Detroit, that they grow over time.
Yeah.
Markets ebb and flow. They all do. And the key on a legacy wealth and holding for long period is that you're just going to ebb and flow with it. And when it goes down, it's going to go down. We can't control that. We just adjust our rents and it goes with it. And when it comes up, we enjoy the ride up. If there comes a time where we're in a market like we are right now, so let's say we bought a property 20 years ago and we're on a market like where we are right now, we're probably looking at some buy or some hold and sell decisions, because market's just too doggone hot not to at least consider selling if you've been holding for 20 years.
Right. Right. Dave, I have to concur with you. And my criteria is very specific, and I have to just concur with David. I can't say nothing else. I can't say nothing.
No, I mean, everyone definitely has some good views. I think it varies. There's definitely good things about the legacy wealth. But at the same time, I know a lot of people that are looking to churn their money, pretty quick as far as, getting that high equity multiple. And yeah, 3 to 5 years, it depending on the type of investor, it could be long or short. And there's some flexibility about, the refis or supplementals in there. So I think it's good to have a little bit of both, maybe some cash flow, and then some you just churn your money and try to make it work as hard and fast as possible. Because obviously we know the faster we can get our money out into something else, we're really making it work hard. So I think it just depends.
Well, everyone has their own strategy of doing things. And the beautiful thing about commercial multifamily, there are many platforms, there are many strategies, there are many niches that you can get into in this industry when it comes to commercial multifamily. So,
and as you know, what's great about it is you can control the appreciation too. Yeah, that's the great stuff, because that's how we make our pro formas.
See, I'm an older dude, so I'm not in for all that fix and flipping. I'm an old cat.
Right. I've seen some submarkets, and I've seen some areas where these properties start to decline because of the neighboring properties. Their owners start converting those properties into subsidized housing, Section 8 and all of that. And you're basically forced to either sell or convert your property into something similar, and it becomes a C class. Those areas might even get worse to D class because of the area and people moving out. So that's what I've seen in some places in Maryland, for example. So that's why I'm bringing it up.
And everyone here is pretty smart. They're constantly evaluating the market. If any of us got a sweet deal, we'll have to look at it twice for sure.
And Tim, to what you just said, that those are forces we don't have control of. They definitely weren't there when we purchased. Right. We do a future look of about 18 to 24 months. You can't go beyond 24 months. No data exists to take you beyond 24 months. And if you're looking at the AHS American Housing Survey with Census and using their 5-year numbers, you deserve to get bit. You should never go beyond 2 years, ever. Our 5-year pro formas are that, they're guesses, but at least there's a little education to it. But my point is, things are going to happen. Jobs are going to be lost. I mean, look at COVID. Nobody predicted that. And when something like that happens, you just have to make decisions. And that's what the management team is for, and decide, do we want to work through this? do we want to adjust with the market, or do we want to sell and take our proceeds and go play somewhere else and hold for 20 years somewhere else? So that's why we have a management team.
And yeah, projections are projections, right? I mean, a business plan is going to change a lot of times through the whole period. You got to be nimble enough to adjust to that and not treat it as gospel, right? I mean, it's going to be evolving constantly.
Biggest caveat is the government.
Oh yeah.
But
So at $10 million was your offer price for this property. It met all your return criteria?
No, Jim. It was we offered it at 935, around 935, 94. We could go up until 94, 945, but at $10 million, it did not hit what our criteria was. Yeah. And speaking of business plan, let's go into the P&L. I'll try to keep it short. I mean, there's this section, there's nothing much that changes from traditional underwriting models. Your income, your expenses. One thing that I do like is, I mean, it's just a visual thing, but your actuals are on the left if you want to compare. And I've just added some indicators to suggest what my income increases in years 1, 2, 3, and so on. So even though it's a value add play, I'd like to keep my income flat to minimal growth in years 1, especially during these times where you might have challenges of moving people out, and you might have challenges pumping rent. So a modest increase in income right here. Your GPR, this is the additional rent from rehab that this model calculates differently. This is your GPR from a gross potential point. This is the rent that you get from your renovated numbers here. So this refers to the rehab schedule and adds as much rent upside you can have in year 1. And that kind of computes it that way. Again, this is opposed to what most models have, which is a burn off of loss to lease. This is saying you have a baseline, show me how you're getting to that extra rent. And that's coming through your rehab schedule. So that's where this number comes from. You have your RUBS income. Your organic rent addition is where you would not renovate those units, but you would try to renew the leases at a higher amount, which is also something that you can add. Expenses, nothing too special there. Again, I can go into deal specific things, but I think.
What? So I got.
Go ahead.
John. Yeah, John's still here. John, are you paying $650 a door for insurance on your other property?
David, you I was about just to say that. Yeah.
I mean, that's what we're paying on the Gulf Coast with Hurricane Central happening down here is $650 a door.
No, good.
I mean, you guys got some tornadoes you got to worry about every once in a while, but nothing like what we do.
No, this property did have fire damage and hail damage in the last within the last 2-3 years. So that's the reason for these insurance numbers going up. Usually we see.
Did you get that from a broker?
We got quotes from the broker, and we also ran the loss runs to see. John actually worked with a broker on that one. He had loss runs run, and those were going to fall off in 2 or 3 years. But at least until then, we would want to underwrite to whatever number is here. There's the insurance again, 65. So you see this customization here. So it says right here, fire damage. And then perhaps 50 to 55 year 3 onwards. So this is something that the brokers came up with. We didn't have a lot of control there.
Okay.
Yeah, it was. We looked at a few brokers, and it was fire. I think they had a couple $100K of fire.
Yeah.
They did have a roof claim for a couple $100K too, but that wasn't as big deal because it was more hail. And then it would come down. After 5 years, it should definitely step down. But normally it'd probably be closer to probably about 50.
Probably closer to 450 to 550 a door. Is that what we see in typical property, John?
Yeah, I mean, that'd be closer, even maybe probably in the higher end. But nowadays, especially in Oklahoma and northern Texas, it's going up just because obviously we know lumber prices, material, labor, all that stuff has really increased. So we've been really trying to verify insurance. That's for sure.
Yeah.
Did the brokers tell you about yearly increases on the premium?
On the insurance, Tim?
Yes, on the insurance. Typically, there's a 2% increase like yearly, and I'm not sure since you already kind of like.
I usually underwrite to a 2.5, but I want to be a little cautious on the insurance side because that's something that you cannot fight back very easily. It is what it is. I want to start moving my insurance up 5% every year. I know that's aggressive, but I'd rather be not, surprised very badly at the end than be surprised with a huge bill. So I think they escalated by inflation, like 2 to 3% every year.
When I was talking to some of the brokers too, is not only obviously we got all these other expenses going up and weather change and patterns a little bit, but they haven't had to really fight so much because there's so many people in the multifamily. So we need to stop buying.
Quick question.
Hey, and just FYI, I'm an insurance agent, and so I know that when you've had fire in a property recently, it can it stays with it for a little bit.
Right.
Like I think about 3 years is generally like how long that those can last, but then it should go down after. I mean, I think you said the fire was 2 years ago, maybe.
Yeah, the fire was 2 to 3 years ago, so it would fall off in another
2 to
2
3
years is what we were thinking. That's what
it would step down.
that
And some carriers, which is really important. Obviously check the safety standards, whether you need all these exit signs, fire extinguishers, everything like that, the correct exits. But some carriers, I believe even Berkshire Hathaway, maybe require you to put in like sprinkler systems if it's over 16 units, I believe, and that's substantial cost.
Yeah, 650 is definitely pretty high, but Tornado Alley, you just never know what some of these carriers are gonna come up with.
Yeah, I think if it were not for the damage on the fire and the hail side or the roof damage, this would fall pretty much between 45 and 50, maybe $55,000 for 100 units, which is 450 to 500 a door, which is what standard properties would look like. But this one did have those loss runs.
Quick question for you, Vivek, John.
Go ahead, Jim.
It's about your organic rent addition. Before I owned a home, I rented, year to, in multiple years, and it always factored in a yearly percentage increase. I've never seen, personal or haven't counted it yet with multifamily month to month contract. Do they factor in any percentage increase or how does that work?
You mean increase from 1 month to the next?
Yeah, or like after 6 months, it's going to go, up 10%.
I don't think we saw this on this property.
Yeah, well, yeah. Currently, I don't think they did. I don't know. I think it depends. If you're going through like a value add strategy, they'll probably keep that more flexible. So you could change with the times. But maybe if it's more stabilized, then they would.
Yeah, although a property that we looked into, I think last week or this week, they had something called a month-to-month premium, meaning if you decided to go on a month-to-month lease, you pay a premium for the flexibility of getting out anytime you'd like. That's something that I have seen in certain properties.
That makes sense.
Yeah.
Because my thoughts is if somebody's got a decent rent and it's month to month and 3-4 years they're paying the same rent, how are you increasing them as the market increases?
Sure. Yeah, there's a month-to-month premium. I think they charge it at
at the time you sign the lease or whenever that is. But there's a line item in the income side
I
which
see.
says month to month premium.
That makes sense.
I've seen some T12s have that. One more thing I want to point out, if you're using the vanilla analyzer, I don't like this, but they put the cap, the replacement reserves below the line. So your NOI is actually higher. Usually, traditionally, even lenders, they want to put it above the line to make sure that your expenses account for replacement reserves. This analyzer in its purest form does not do that. So you want to be careful about that factor.
So and you guys have probably heard me say this before, that this is a big sticky point with me.
The NOI above
Reserves,
the line? Sorry,
no. Reserves are just that. They're not expenses yet. So if I were to build a model and I was paying all cash for a property, that's exactly how it would look, because you haven't spent that money. That belongs below the line. The only reason and this is the old, if you're a broker, and I know Daryl's run into this, the seller wants it below the line. The buyer wants it above the line because it affects the NOI. The buyer has a great argument. The seller doesn't care. The seller's still going to price it like it's below the line. But the buyer's putting it in above the line because your lender, typically the agencies, it may be different with some of the smaller lenders, but the agencies especially, they're going to put those reserves above the line. And that's why the buyers do it. Correct. And they know it. And whether it's all cash, whether they don't even have to have that requirement, they're putting it up there because they have that excuse. And so that's why you see the discrepancies.
Correct.
Technically, it belongs below the line.
You're saying by definition?
Yes, because it's not an expense. How is a reserve an operating expense? It hasn't been spent.
Makes
So
sense.
David, you're saying you when you underwrite deals, that's how you underwrite it. You put it after the NOI.
Depends on who I'm representing. If
I
I'm
gotcha.
representing the seller, it's below the line. If I'm
I
representing
gotcha.
the buyer, it's above the line.
the line, yeah.
Heck yeah. Then it becomes a negotiation.
I gotcha. Okay.
Actually, opposite an expense. It's cash in hand.
And actually, I look at who my lender is, because if my lender says put that thing above the line, I put it above the line, and when I submit my LOI, well, I always submit a cover letter with my LOI, always. So my LOI is my cover letter is going to explain, number one, my underwrite and why my reserve is above the line.
I see.
Great point, Daryl.
Now, Daryl, have you seen any lenders come below the line? I haven't seen any.
Have I seen a lender with below the line? Yes,
Yeah?
I have.
Are these more non-agency type of lenders?
Nope.
Or?
Nope. And actually, I think the name is Stillwater. I have the underwrite around here somewhere. I have to find it.
Is that a life company, Daryl?
No.
So this is Fannie Freddie? I mean, they underwrite to Fannie Freddie?
Yeah, they underwrite to Fannie Freddie. Yep.
Okay.
I have it. I think I have it on my computer. It's but I think they call Stillwater or Sweetwater or one of them. Stillwater, Sweetwater.
I've seen a lot of regionals, credit unions on some of the smaller deals where they underwrite it below the line.
Below the line.
Yeah.
Gotcha. So yeah, I mean, nothing too different as far as the P&L is concerned. You have your other metrics like debt cover ratio, debt yield, purchase cap, all-in cap, and of course your break-even occupancy. Nothing.
Will this model, I think I already know the answer to this because I ain't seen one yet that does it. So the lender is going to lend on LTV or debt coverage ratio, whichever is lower, the lower amount. So most times, and in this one I can see is the case, it should loan on loan to value. Does this model adjust your loan amount based on the minimum of, or is it just telling you what the debt coverage ratio is and it goes off of the loan to value?
So one thing that I look for is I have a flashing red red shade here. So say I'm going with say 0%. I mean, this deal doesn't fail even at 0% down payment, but let me say, sorry for that. So here you have your markers, right? Say your year one DSCR hits below 130, then I have a flash happening here saying, hey, your leverage is too high, or you're not able to cover your debt with enough buffer.
So when we rebuild it, you're going to put this up somewhere for us, we can get a hold of it, so we can reverse engineer it.
Sure, I can share it with a few folks, but I don't want to publish this because this is something that I bought from another guy. I don't want to jeopardize his business model, if you will.
Okay.
I can share it with.
We can put into this model the minimum of. It's not that hard to do, and
Sure,
none of the models do it.
No, I can
why.
share it with a handful of you guys. That's fine with me. But I just don't want to put it out there in a general Slack channels because that's something that might come back and.
And I would recommend don't share it, even with some of the guys, because this is the GOB, and we share. That's one of our models. We GOB. And
right. If it was a free model, then I would have no problems with it. But I bought it from someone. I can check with him to see if there was a partnership that he could do. It's something I can do, but you don't want to give anything that is not mine, essentially. Yeah.
No worries.
No worries.
So yeah, that addition is something that I could do, David. Yeah. Coming to refi exit, pretty much standard here. You have your refi and then return metrics. This is pretty much what even SDA does today. Closing costs, again standard. We just use the standard here, but we can break this down into all the different fees that there are. CapEx and reserves, the last tab. Here it breaks it down into equity funded and the reserve side. So you have your per unit CapEx, which is your interior and exterior renovations. Plus, I also like to put a month of working capital, which is 1 month of expenses plus principal and interest. Tax and insurance reserves is 12 months. P&I reserve is 12 months because it's going to be Freddie Mac on the small balance side, or Fannie Mae. One more thing that I have added as a tweak is I consider these principal and interest reserves redistributable in month 12 or in year 2 onwards. And that adds on another distribution. It's an additional distribution where the reserves can be taken out now. That's something that I modeled here, which I don't know what you guys do on that side with the Fannie reserves of 12 months. Do you guys?
And I know you've probably heard this, but that is not being calculated in the internal rate of return, correct?
This is being calculated in the cash flow, cash on cash, which in turn reflects on the IRR.
You need to change that. That is incorrect. You are returning investors' money to them. That is not a return. That's a return of money.
There you go. That's return of.
That's return. Right. That's return of capital if you dilute their shares, right?
No, you don't have to dilute their shares at all. You're just returning unused capital to them. That's it.
Got it.
You do not dilute anything. But if you're going to return it back, the best way to handle it is just leave it in the investment. Just transfer it to capital expenses or capital reserves or some other reserve, and just leave it in until you dispose, especially if it's going to be a 3-5 or something like that. Because the biggest way to flag the SEC is incorrectly redistribute reserves.
Got it. So question to you guys. I mean, are you using any creative methods to make your deals work, even though you have the 12-month reserve sitting in account for 12 months? Meaning, are you saying you'll raise less in CapEx and then use that in the second year Are those some of the creative methods that you guys are finding in deals these days? Because return off capital is something, yes, as David mentioned, it's a big question mark. But any other creative ways that you guys have found?
Yeah, on what you can do, the money that you say you're going to raise for
CapEx.
Yes, thank you.
No problem.
If it's less than what you have, if it's less than your P&I reserve, then it should offset. Now, it's what the factor is. One, on your plan here, you're being really aggressive. So I don't know if you doing 4 units every single month, and that's really aggressive.
Sure.
So your expenses, I don't know if you're going to be able to wait for that 395 to come back. If you would say, okay, well, we could do like 2 a month and stretch that out so that in year 2, when they release that 395, you could then go ahead and use that to go ahead and finish off your reserve. So whatever your total budget is, like you're 5,000 or 5,000 a door, you could just subtract the 395 from that 600,000, do the work, say 2 units. I'm just going to say 2 units, say a month. And then in year 2, you could go ahead and take the rest of your capital, finish off the rest of everything that you need to do and get it done. But you're being very aggressive. You got 4 units every single month. That's, yeah, you may spend through your
before your release happens.
Yeah, before that money's released.
And we've had, go ahead, David.
Just remember, everybody's got the same requirements you do.
Yeah.
It's all apples to apples.
Sure.
It's just a matter of your risk versus their risk. If you're underwriting to SDA and you're using a 14% internal rate of return, which is what it tells you need in order not to go red on the internal rate of return, then you're using Michael Blank's risk. And I'm a big proponent against not doing that. If you promise your investors a double-digit return and you're using a 14% IRR, and the IRR comes out at 13, you're going to get a red and you're not going to do the deal because it gave it to you red. And you adjust the purchase price to get it over that 14, which is why you're now lower and why you're not winning any deals. So
Sure.
It's all a matter of risk. And your more experienced folks know that they can come in and say, okay, well, my risk on this property, since it's stabilized, since it gets a 90% collection, that's all pretty good. There's a little CapEx that's got to be done. It's in a nicer part of town. It's in a pretty good market. It's growing. So maybe my risk is 8% or maybe my risk is 7%. So they can actually pay, if your risk is 12 or 13 and their risk is 7 or 8, they're going to beat you every single time.
Right.
So it just depends on the risk level between the people that are fighting for the property. So if you're losing deals, it's just because you're a little more risk averse than the folks that are winning the deals. They have a little bit more risk tolerance than you do. That's all that means. It's not a matter of playing with the numbers.
Return.
It's all a matter of risk.
Right. I mean, you're willing to take more risk for the same return or the otherwise, or the other way around.
So they're bringing teams in. You guys, I know you see that they're putting $200,000 to $500,000 hard day one.
Sure.
But here's what they're doing. The brokers have these call for offers. And they say, okay, we're going to have tours on this date. We're going to have tours on this date. We're going to have tours on this date. It's typically 3 to 4 times they'll do tours before the call to offers is due. So these companies will send their teams in so they can do all their underwriting. Literally, they're doing 80 to 90% of their due diligence. The only thing they're not doing is walking every unit. Other than that, they are doing 80 to 90% of their due diligence before they ever submit an LOI. So when they submit an LOI, they know they're buying that property at that price, which is why they can come in at $200,000 to $500,000 down hard day one. Because if they don't win, they get that money back. It's only if they win that it becomes hard. All right. So if you want to be competitive and you want to be able to put that money down hard, be like the other companies and do all your due diligence other than walking every unit, because you can't,
prior to LOI, but get everything else done. Go to that market 3-4 times. Go walk all the comps. Pull, talk to the county, talk to the city, get your underwriting done for the debt, get your underwriting done for insurance, everything you need to do. Talk to all your vendors, find out what it's going to cost for all your closing costs, get all that underwriting that you need to do done, all your due diligence, so that all you have to do is verify once you go under contract. That's it. You're good. You're closing.
At that point, you're not guessing. You have everything. You're just, double checking.
The only thing you have not done is you haven't seen the leases. You're not going to get to see the leases.
Sure.
Okay. So that's you. If they send you, they're advertising, this is what we're advertising them. And the brokers know this. If they tell you that this is what it is, and you get something different, you can argue that and get your money back. You can win that in court. So you have literally everything you need other than verifying the expenses, because you're going to want to see expense receipts. You're going to want to see income receipts. You're going to want to see leases, things like that. You can't see that prior to the LOI, but that's not something, there should be no red flags because you've been promised something. And if something shows up that wasn't promised, you can fight that. That's not that big of a deal, but you've underwritten everything else. You're purchasing this property. I mean, if it's 90% occupied or 100% occupied or whatever the occupancy is, and you can't get into those units, people are living there. They're not going to be that bad.
Sure.
Right. No, I mean,
that's how you be competitive.
I totally agree. I mean, that's I feel like you have to do that. And that's why we've actually put so much effort into the LOI and getting all these quotes, because if you're going 100, 200K hard day one, which it's like you're expected. Yeah, that's essentially how you got to go in thinking, if I'm putting hard money day one, we've already bought this property for sure, because that's who you're definitely competing with.
And that's correct. And so you need that team in place even before the LOI. And if you're not in your LOI putting hard money day one, I guarantee you're not one of the 2 or 3 that gets sent to the owner for final.
The best and final.
Yeah, for best and final. You will not be part of best and final.
And it's definitely easier with definitely well-maintained property. And this property was that. I mean, if you've been like everyone here, if you've been around properties, you can pretty much tell generally, just walking through a few. They're all going to be the same. Yeah, you're going to have small stuff, but I mean, other than maybe seeing like a sewer, you can see most of it. Question on the Daryl, I know you mentioned about the rehab schedule, and I'd like to get other people's opinions too. I know, other people's preferences, whatever teams they have, the size of the building. Let's say assume you are you're doing X number of units a month. How do you guys, maybe it's personal preference, determine how aggressive it is, assuming you account for the possible vacancy?
Well, go ahead,
No,
David.
go ahead, Daryl.
No, you go ahead. Go ahead.
So here's what I did. When I syndicated the value add that I did in Texas, it was a 40 unit. We had a plan of doing what was our renovate? It was 15 units that we were going to renovate. And we were going to renovate 1 unit a month. And in order to get there, because we were 100% occupied when we bought the property, in order to get there, we knew we had one tenant that had to go. So we evicted that one. We actually had in our purchase agreement that the owner had to pay a little extra for that eviction. So we got that covered. We evicted him and we started that first unit. While that first unit's going on, we're doing the exterior. So we're getting all the exterior done. Now the tenants are seeing the exteriors getting done and this one unit's being renovated. Now they start to get excited. They're like, oh, you guys are renovating. Awesome. When do I get my unit renovated? Okay, great. Tell you what, when unit 3 is done, are you willing to pay the extra $100
and move into unit 3 when it's completed? Absolutely. And so we'd take that tenant and we'd move them into unit 3 so we could do unit 5. And we did that, and we actually finished, it was about a month behind schedule. There were some other factors that caused that.
So within a
Our
year, you could
problem-
do 15 units, sort of. That was your business plan, and you kind of stuck to that.
Yeah, yes, that was the plan, and we weren't gonna kick anybody out that didn't deserve to be kicked out.
Sure.
And we didn't raise any rents on anybody that had month to month if they were paying. If they were good tenants, we wanted to keep them, because this was a complete reposition. This was a bad property, and we took the next tenant and we did the same thing. Okay, you want to move? Great. Pay the 100, you can move. We had some turnover. Our problem was, it wasn't the value add. We let, and comes back to what I said before, we let the property manager do the renovations because he was a general contractor. But they focused on the renovations. They did not focus on the property management side. So even though our renovation budget made it, we were on budget, completely on budget, which is a miracle. Nobody's ever on budget. But we made it on budget. We were a month late, but they couldn't lease the units back up because they were so focused on the renovation, they didn't focus on the leasing. The one thing they should have been focusing on. So that was why I was so emphatic about not using the property management company to do the project management. In this case, it was the other way around. The project management company was supposed to do the management, and they didn't. So that's how we did it. That's how we managed it.
Right.
I have a question for you guys, if you don't mind. You said you were about a 4 or 5 year hold time for this property?
Yeah, let me.
I think I thought we were at 6 or 7.
Yeah, 6-year hold time on this with.
So
yeah.
My question is, why are you being so aggressive with the renovations to get it all done in the first 2 years, when maybe you could, use some of the COVID restrict, the P&I, maybe
The
in a year or 2.
reserves?
Yeah, the reserves.
Right. We did plan for that. We did plan to do a refi in year 3 or year 4. So we did want to get the value up to quite a bit to do that. And without a refi, without this aggressive of a plan, we were falling very behind what the numbers were expected. And even with this aggressive of a plan, we couldn't hit the $10 million that they were asking. So it was a very best offer, very best business plan, best case scenario that we put in an offer for. And yeah, John, did you have something there?
Oh, I was just saying, and like I said, everyone has different preferences too. We definitely make sure with whoever we're going with for the renos, can you handle these number of units plus even extra? So we didn't plan on, we assume we weren't close to overloading the team that was going to reno these. So that, of course, that's definitely a big factor.
Gotcha. Good.
Vivek, you're going to be, I'm assuming, syndicating the deal?
Yeah, I mean, we're still looking for deals in Kansas City, but yeah, that's the. I mean, I focus mostly on the underwriting part, the business plan, lending. John focuses more on the asset management side. He's local to Kansas City, so he can tour properties, shop comps, and that kind of stuff.
Oh. So you already have your team in place for to raise your capital and everything?
We speak to a few folks to see if if this deal is definitely something that we would need partners on the equity side. We are talking to a few folks, and we got a few people to take a look at the underwriting a little deep. They were happy with what they saw, but they didn't want to stretch too much in the direction of $10 million. So we have been engaging with a few folks, but open to talking with other folks as well.
Mm-hmm.
Yeah, I mean, we're definitely open to partnerships for sure, as much as the next guy. So
Now,
If
now
you guys,
are you the both of you are part of GOB, right?
Should.
Yeah, we are part of the GOB network. Yep.
And did you talk to people in the GOB?
We've engaged with a few people, Daryl. We want to make sure that it's a market fit and also a personality fit, and that's something that we want to see how teams look at deals and how teams present deals, and that way it's more of a relationship that we can take to deal number 2, 3, and 4, and not just a one deal and then just say, we want to grow this for the long term. So we've spoken to a few people here. They brought deals to us, we brought deals to them, and then those conversations are happening as we speak.
so you guys wanted to know how to be more competitive other than having hard money down. The other way is talk to different investors. So if you're promising 14, 15, 16% returns, then your risk level's pretty high.
Sure.
If you can find investors, start prospecting LinkedIn, different places where you can build relationships with family offices and some of the bigger sponsors. And I don't know yet. We have some sponsors in GOB. I don't know what their risk level is, what kind of return they're expecting. But if you can get it down to that 7-8% level, you can start to be a little bit more competitive on some of these deals and get you at or above that purchase price. But until you get your risk down, you're not going to get there.
No, that's a good point. And just a curious question to the forum, right? I think we have quite a few folks still on. I appreciate that. What are investors looking for in terms of returns? Are they still looking for mid-teens, high teens, or it depends on the deal? I know, Daryl, you guys closed a deal in South Carolina recently, yeah?
Georgia.
Georgia, sorry. Was most of your investor base looking for something along the mid-teens to high teens returns, or have investor preferences changed more to cash flow? What are you guys seeing these days?
Wow, that's hold on a minute. I'll tell you right now, because now I don't remember the top of my head. I got to open it up. We came in at a 2.14 equity multiple, 16.33 on the average cash on cash, 21% IRR.
Got it. So it was definitely the 20 IRR sort of a deal, which is more than 2x the equity multiple.
Yeah.
Are you seeing deals hit those metrics more often, or you're really having to hunt for those deals? How's your experience been in that regard?
I'm going to say that 21% is, I'm going to say that's a really good thing, and that was a really good thing because of I'm going to say because of the seller. That was a really a good opportunity. However, what I think the best that I've seen is probably 18%. That's coming in between 16 and 18% with an IRR. But the deals are out there, and I think it just takes a little ingenuity of underwriting and stuff like that. What do you think, David? What you saying?
If you're
Yeah,
only responding to call for offers, and that's kind of where all my comments have been on broker call for offers, Cushwake, CBRE, ARA, Newmark, Berkadia, JLL, Marcus Millchap. If you're living in that world, in order to be competitive, you got to get down to that 7-8 risk level. So 7%, 8% IRR. There are investors out there that will invest in that, because if you read the article recently on Wall Street Journal, 90% of the what are those mutual funds? 90% of the mutual funds missed the S&P, and the S&P's been living around 8 to 10% the last 7-8 years, and they haven't made the S&P, haven't even caught the S&P anywhere close to it in the last 6 years.
So these are actively managed funds.
These are actively managed funds that are taking fees. And then the whole point is, what are these funds doing with their fees? They're not
Sure.
even protecting their investors. And that's 90% of those funds that was in this article. So there are investors getting low returns. 7 and 8% looks good to those investors. You have to be able to find those investors, market to those investors, talk to them, build that relationship with them, and let them know, stop getting that 4 or 5% from that mutual fund. Come over to us, especially bonds. Bonds are a little bit more safe, but come over to us and we'll get you a 7 to 8% return. When it's all said and done, you're not going to do a 7 to 8%. I'm going to tell you that right now. Your performance is going to show 7 to 8. It's going to make you competitive for the property. You're still going to do a 14, 15, 18% return when you sell that property, because the market's going to go up and we're not going to predict how far it's going to go up. Remember, we're always adjusting down on our cap rate, or up. I'm sorry. We're always adjusting up on our cap rate.
Yes.
So if I'm buying it at 6, I'm probably selling it at 6.5 in my pro forma, or 675, because we're trying to be conservative, because the lender wants us to be conservative, because they're going to be conservative. So it makes the numbers skew a little bit, knowing that that is probably going to be a 5.25 5 years from now. But now we're looking like we're puffering it and we're fluffing the numbers. And so we can't do that. Perfect example, the 60 unit that I owned here in Mobile. We didn't have any distributions for 3 years. I wasn't the sponsor on it. I was a passive investor. I brought them the deal. I made a commission. I put half my commission in the deal as a passive investor. Come time to sell, they came to me. I had my investor goggles on, not my broker goggles. They said, David, we're ready to sell. I said, great. What do you want to sell it for? We bought it for $1,575,000. They said, we want to sell for 2.6. I said, let me see the financials. They sent me the rent roll. They sent me the T12. I laughed at them and said, there's no way in hell I could sell this for 2.6. Again, investor goggles on, not broker goggles. So they said, can we shop it? I said, absolutely. I want my money back. You guys ain't paid me a dime in 3 years. I'd like to get my money out of this. And so they shopped it. And the group they shopped it to did a call for offers. 3 full price offers with hard money down on a 60 unit in Mobile, Alabama. I blew my mind. So I took my investor goggles and I threw them away. That'll never happen again. I promise that. I lost a $300,000 commission because I was stupid, because I had my investor goggles on. My point is that I didn't receive a single distribution. I was promised a 15% return. You know what I ended up getting? A 56% return.
In 3 years?
In 3 years.
Wow.
So that's good.
Good.
Okay. So I'm not telling you to guess like that. I'm just telling you that you can be a little bit more aggressive. You can lower your risk a little bit. Your investors will still be okay. Just remember, as long as you underwrite to their break even, you don't ever want them not to get their money back.
Mm-hmm.
But as long as you underwrite to their break even, you're probably going to meet or exceed their expectations. Never, ever underwrite under their break even, ever. They are your own, they are the responsibility, first and foremost, 100% of the time. I don't know how else to get you guys to lower your risk tolerance. But until you do, you're not going to be competitive in the call for offers environment. Off market's a completely different story. You control this. Well, seller still controls the situation, but at least you have negotiating room there.
Sure.
I am only talking about call for offers.
I have a question. What do you do when you're using 2 different analyzers, to trying to get 2 perspectives and they're nowhere near as far as returns? Like what, I mean, I'm at this for the group essentially. What, which way do you go when you make that
Create your
decision?
own, because one of them's broken and you don't know which one, unless you understand Excel. One of them's broken. So that means you got to go in and do it yourself.
Yeah.
That's a great point David was bringing up. So every time you guys look at new analyzers that look pretty cool, they can do this, they can do that. But a lot of people don't consider that a lot of bugs. They have bugs that you don't know, you won't find out until maybe too late in the game. So You have to look at them and you have to figure out how they work, what numbers are going in, what numbers are coming out. You have to verify. And
We
yeah,
like the
develop
one. We like the one with higher returns.
it.
We've
I'll
had
buy that for $1.
we've had that where we've had other people underwrite and be like, "Oh, yours is a percent and a half higher." Be like, "We'll go with yours."
No, but yeah, I mean, absolutely. You want to make sure that you understand what's going in, because you put garbage in, you're only going to get more garbage out.
You got to go
wanna-
line by line and just follow the flow and see.
Yeah,
what-
I mean, we always want to make sure. I mean, I think even in this one, John, we underwrote it with SDA, and it was very much close to what we were getting. So no surprises there. But every now and then you make a mistake, and maybe the model itself is inherently bad. You don't want to go with that because you're playing with investors' money with that.
Yeah. The one thing I've definitely learned from dealing with models is don't break the cells.
Yeah, but that's so
Don't
hard
break
not
the
to,
cells.
right? It's like
If-
I'm gonna
and-
manually change it.
Yeah, and because when you do that, I guarantee you're gonna screw that thing up.
You'll
So
forget about
if
it.
if anything, learn the formulas and learn how to work with the formulas so it doesn't break the cells and break everything else.
Right.
Okay. Because I used to break the cells, and then I realized that the numbers were screwed up. Then I had to not throw it away, but delete it, and get a whole brand new one, do it over. But now, no, now I don't break no cells. I will add to the cell so I could go back in, but it keeps everything flowing, in its perspective. That's the only thing that's one thing I think I don't like about the SDA is that it doesn't give you that capability to adjust your rents when it comes not to the organic, but to the bumps that you need to do. You got to go in. You're gonna either break that cell. You're gonna do one or two things. You're gonna either break that cell on that P&L tab, or if you know what you're doing, I usually just go in and I will add to my cell so that it will flow. But then I got to come to the next year and bring it back down to keep it going. So you have to, if you're not good at formulas and values and messing with these Excel forms, I tell everyone, don't break that cell. No matter what, just don't break the cell.
And the CCIM Institute at ccim.com, under education, there is a Ward Center course. So if you click on education, then click on Ward Center courses, called DCF Financial Analysis with Excel. It's a 5-day course. So he does it every 2 days. So like Tuesday, Thursday, or Monday, Wednesday for 3 weeks. And each session is an hour and a half. Jeff Ingolstad, who is a professor, he's a CCIM professor at the University of Denver, has a PhD in mathematics, teaches you from scratch how to do an entire discounted cash flow analysis model for 10 years. And that's all you need to know about Excel. Once you take that course, you will never need another Excel course ever again, because you'll be so pissed off you took the course and you'll want to, because now you're going to want to go build all these DCF models once you do it. So
where is it under education, David?
Yeah, under education, and then under the Ward Center. And then once you get into the Ward Center, just search DCF using Excel. It's the 5-day course. He's got a 2-day course and a 5-day course. The 2-day course, you write a model just like mine. Again, I don't have an original thought in my head. I was taught how to write that model, and I created it from that. Added some things to it, obviously, because I made it for multifamily. And then the one that we use at CCIM, which is a big complicated model, that's the one you do from scratch. There's like 5 or 6 tabs to it. So you're transferring back and forth between tabs. He shows you how to use GoalSeek, which we all got confused over a few weeks ago. But it's a great course. The 5-day one's great. Both of them are, but the 5-day one will pretty much give you all you need to know about how to build a financial model.
David, do you use the APOD?
Not very often. The APOD's so basic. I mean, I could do the APOD in my head. I don't need to put it on paper.
You got to love the goal seek. That's something that eases your time a lot. Yeah.
Well, so look,
Maybe
these models, none of these stupid guru models, none of them actually tell you what you can pay for the property. Not a one. The first thing you need, and a lot of these guys have heard me say this. I don't know if you have yet, Vivek. I harp on this all the time. The first thing you need to know is what's your risk level. It's called a discount rate. So if I want let's just use 15%. We've been using it all day. If I want a 15% internal rate of return, that's basically your discount rate. Sure. When your internal rate of return on your model equals your discount rate, so 15%, that means your net present value is 0. Meaning we took the internal rate of return and we discounted it back all the way to year 0 at 15%, whatever that discount rate was. So when they're both equal, it's 0. If my discount rate is higher than my internal rate of return, meaning I had a 13% internal rate of return and a 15% discount rate, I'm going to have a negative net present value. What does that tell you, Vivek? What's that negative number tell you?
So your IRR is lower than your discount rate?
Correct. But why is it negative? It's going to give you a negative number. What does that negative number tell you that you need to do?
In terms of goal seek or?
No. So it tells you you need to lower your purchase price by that number in order to get that 15% internal rate of return.
Because you want to go high on the IRR and make it equal to the
I want a
discount
15%
rate.
internal rate of return, but I only got a 13. So using net present value, I get a negative number. If that negative number is 200,000, I know I got to lower the purchase price by 200,000. That becomes my strike price. Okay. I can't offer more than that and still get my internal rate of return. If my net present value is positive, that means I can actually offer more for the property based on what that number is and still get my 15% internal rate of return. None of the models do that for you. None of them, not a one. There's two things they're missing that has been a pet peeve of mine. They do not do the minimum of loan to value or debt service coverage ratio automatically for you, which it should, because it's easy to calculate. And they don't do net present value, which tells you what you could pay for the property, which is the whole purpose of underwriting in the first place.
Sure.
That's my soapbox. I'm off.
Hey, can I put up the CCM course real quick and you can tell me which one it is? I definitely want to take a look at it.
Yeah, don't mind interrupt you, but I gotta head off. I have another thing coming, but thanks all for being on.
You got it.
For a long time.
That was excellent, Vivek.
Great job.
I appreciate the inputs, all of you. Thank you so much. And I see a lot of people hanging out even here. But John, thanks so much, man.
Thank you, guys. Good job, guys.
All right, John. Excellent.
Thanks, John.
I'll see you guys on a call.
Okay.
Thanks.
Bye.
Bye, guys.
Bye.
I'm still here.
I'm still there, Dave.
Am I in the right? Oh, I got to share here.
Jim.
Sorry.
Jim, if you want to bump, you can give me controls.
I don't know what that'll do, David, to
no worries.
recording. So
it won't affect the recording. I'll just shift the recording to me. All right. So what's your DCF using Excel? Jeff Engel using Excel, and it's not that one. It's not that one. Keep Excel. No, keep going. Keep going. Oh, hold on. Go back up. Up. He may not have one coming up. So go to the top. Go to education. Click on Ward Center Real Estate Studies. Scroll down. Keep going. Click on Financial Investment Tools. Scroll down. All right. Hold on. Wait. Real Estate Financial using Excel. There it is. That's it right there. Real Estate Financial Analysis using Excel.
Cool.
Click on upcoming courses. It'll tell you when the next one is. So you're a non-member, so it cost you $500.
Okay.
Well,
how do you know if that's the 5-day or the 2-day?
It's going to tell you right now.
Okay.
See, this is the new Fontiva system. Ugh. And I'm on the tech board. Click course type. So it's F. So you need to scroll down there, click more, and scroll to the F's right there. Financial analysis. Oh, that figures. Keep scrolling down. This new Fontiva model is a pain in my butt. Hold on, wait, up a little. So there's syndication and crowdfunding, splitting profits. That's a great one for you guys. That actually teaches you how to underwrite the waterfall. Scroll back up.
Okay.
Scroll up. Evaluating, make sure you keep going. Development, corporate, construction, development, keep going. Hold on. Advanced market, advanced commercial, tax deferred, commercial real estate. I don't know where it is. Okay.
All right.
I know that's the 5-day one because of its price, because the other one's only like $195 for the 2-day one.
$215, yeah, for
Yeah, something like that. Oh, they increase their prices. Oh, see how they are.
So this guy here.
Yes.
David and Daryl, I just want to let you guys know.
Thank you.
You guys underwriting workshops been helping me out with the underwriting, man.
Yeah, definitely.
Awesome, John. Love to hear
Fantastic.
So that's the one, the real estate financial analysis using Excel. That's the guy. Okay, great. Thank you, folks. I appreciate it.
That's the guy. Okay, Jim.
All right.
All right, guys.
Guys, have a good night. Thank you.
All right. Have a good night.
All right. See everybody soon.
Thanks, everybody.